All right, market started the new week really slowly today. Of course, the Easter holiday weekend that we celebrated on Friday, Europe celebrated today, so I added a little bit to the lack of volume and the lack of interest today. Very light volume, very small trading range, not a lot going on. Of course, the biggest news came overnight in terms of the oil market that had an impact on things from a stock market perspective. But we're starting to see some areas of weakness, right? We're starting to see, while there are still obviously some very strong pockets of strength in the markets, there are some pockets of weakness developing. And another one came up today. We'll talk about trading it in tonight's video. So let's go ahead and get started. Today is Monday, April the 22nd, 2019. This is the market outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. Very, very boring day today. As you can see, the range, 13 points was all that we had. And obviously we filled in the gap that we had in the morning. So a very small range. Short-term sentiment bounced higher, but not too much higher, right? At least they didn't go down to the reversal zone. So we are bouncing from what would be a bullish near-term low. Keep in mind, look at the near-term runs. They're getting smaller, and they're getting, they're not getting higher. So we are very mature in this intermediate run. We've seen some signs of that maturity with oversold near-term lines, extreme lows on the momentum line, that's divergent low on the intermediate line, and now we're getting shorter and divergent near-term runs. So keep that in mind in terms of how likely we are to maintain this without a pullback towards one of these red lines, even if it's just this 23% Fibonacci line, which is now lining up with these old highs or close to these old highs and close to these levels over here, to at least to that intermediate low point, ironically enough. And that would just be a 23% Fibonacci retracement. Of course, if you look at the other indexes, the Dow Jones Industrial Average, this near-term line is we're still on the same near-term run, and it's kind of meandering around here with a very small range today, 94 points compared to 200. Remember that 200 points is very, very low for this past year. Also, the Nasdaq, very small range today, bouncing up from finally getting just a smidgen below the midpoint after being above the midpoint this whole near-term, one big long near-term run that also had a little bit of a divergent high point at the end of it. And we'll see how likely we are for this near-term line to get and make a successive run of this length. Most likely not. And then finally, the Russell 2000 is showing a weak bearish posture, the only one of the indexes. Remember, it was the only one of the indexes that had the dark pink shading and the dark red line. That bearish combination. None of the other ones even had the dark pink, had a bearish posture, right? Well, you look briefly there on the Nasdaq and the S&P 500, and then one day of dark pink shading on the Dow Jones. But you see, we got the red line to go with it on the Russell 2000. So it's different than all the rest, and it's now more bearish than all the rest. Even if the short-term sentiment isn't extremely oversold either on the momentum line or the near-term line. In fact, you see the near-term line's actually been below 50 now for, let's see, this would be the first day right here. So 1, 2, 3, 4 days now that the near-term line has been below 50. That's a pretty decent run, even if it's not necessarily dropping to extreme lows or to sharply oversold levels. That would suggest that we are in the potentially in the running for a bearish trend. Now, also keep in mind too, we have light pink shading, not dark pink, and we still have a green line. So we are still, in fact, if we look at here, the moving average at 1556.21, which is still rising from Friday or Thursday's result. And then you can also see too, we are trading at 1560. So we're above a rising moving average still. So it will still be green tomorrow. So we're not anywhere close to a bearish. This is a weak bearish posture. It's about as weak as you could possibly get because it's at 79th and a half percentile. So just a smidgen below the 80th percentile. So, I mean, yeah, it's hard for the markets to maintain a strong bullish run like it's had, simply because, I mean, I know that there's that saying that the markets don't die, bull markets don't die of old age. Intermediate runs do. So intermediate runs will eventually run out of gas. They will run out of steam and will die of old age. Now, granted, you get the right headlines and you can extend the life of an old intermediate run an extra month or two, but that's not a good sign. As we've seen in the past, every time we've extended past that 3-month mark, the pullback has been a lot more uncomfortable than what people are used to. So we are now not in the Russell, because see, the Russell, we did get the intermediate drop there, but the S&P, we are now 3 months in. We are beyond 3 months actually, because you see we crossed the 50th percentile in the intermediate line over here on January the 11th. So we are beyond 3 months now. So again, this kind of shows that we have a very, very old intermediate run. It doesn't have to fall because we have the right headlines right now, at least keeping it up in terms of watching for those trade deals. It hasn't been as big of a deal because it's Mueller report, but that's what's been keeping things. And now you're in an earnings season and the market's looking for positive earnings. But you'll see later, it's not economic indicators that are keeping us afloat. It's the prospects of better economic indicators that may come from a hopeful trade deal that we'll see. All right, before we look at some other charts, a reminder, subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your screen, then click that red subscribe button that pops out. Hit the thumbs up icon down below the video that tells us you want us to do the video again tomorrow. Quick way to give us feedback. Comment on anything that stands out to you tonight from tonight's video down in the comment section below. Join our daily market outlook email list. There's a link up there in the top right corner of your screen. Click that link up there to subscribe. Follow us on Twitter for more content in between these videos from day to day, and join our market outlook community that we've created on Facebook as well as on marketscholars.com. All right, if you're watching our video here on our blog, if you scroll down below the video, you can see you can sign up for our market outlook email here as well. Just type in your first name, last name, click this blue button to sign up. This is what you get. You get a timestamped summary of what we talked about in the video. You can click on these links. It takes you straight to those sections in the video. Also, if you scroll down to the bottom, you get the overbought and oversold clusters within the S&P 500. This was from last week. So obviously when you open up today's email, you'll get today's list. So make sure you scroll to the bottom of the email to be able to see those lists. A lot of people are missing that because they're stopping here at the top to watch the video. Also, below the video too, you can see the tonight's Market Outlook tweet and Facebook post. Click this heart. That will open up a new video where you can like today's Market Outlook tweet, and then click this image. It takes you to your Facebook account. You can like tonight's Market Outlook Facebook post there as well. Remember, for Twitter and Facebook to keep showing you our stuff, you have to engage with it. So we try to make it really, really easy for you, at least to like it, and that will keep you on their radar in terms of always showing you the stuff that Brandon and I put out there day to day. All right, back to the charts. From a long-term perspective, you can see obviously we have a little small week. We had a really small week last week. The ranges have been getting really smaller. The Haken-Yashi candle this week, you can see, is really small too. So we're getting, we've got a higher potential. You can see the open for the Haken-Yashi on SPY is at 288.08. If you look at the this chart here, and we edit that to 288.08 to update it, you can see now how close we are to getting a lower shadow, right? A transition candle. So now, granted, look at the range, very, very tight range over the past 1, 2, 3, 4, 5, 6 days now, 6 trading sessions. Very tight range. We haven't broken up to a new high in a couple of days. We haven't broken down back into this lower level where we had a really tight 5-day range for a while there. So the ranges are tightened up. The low point, after a couple of days, we'll move up. By the end of the week, we'll move up into here. And of course, once we get into next week, you can see how the range is really going to tighten up to like 7 points, which is really, really starting to get tight. And again, it gets tighter, just like we get those transition candles. The ranges get tighter right before we get that intermediate pullback. after we had that 5% range, which is that rubber band got stretched, and now you see how hard it is to keep going up when the rubber band was stretched as much as it was. 14 points almost. So that's 5% of the low point, not quite 5% of the high, but at least 5% of the low point. So we've stretched that range, and that's why we can't keep going. It doesn't mean we can't go, because nothing's 100%, but it's harder. It's harder for it to maintain that positive momentum when we're stretched as far as we are. If you look at the 3 green arrows, not surprising, we still have this lack of momentum because we're so sideways on the MACD, and you can see now the stochastics are starting to fall down too. As bearish as that momentum is, we're still above an 8-day moving average. So we're not bearish, right? But we're just losing momentum. We're still pretty positive. The MACD is still pretty positive above 0. So it's not close to dropping below 0, which is what makes things bearish. Even on the intermediate pullback, we had to drop below 0 and it stayed there for a while. So we're not close to that anytime soon. Which would require obviously breaking below the 8-day first, then breaking below the 17-day and testing the 30, and then breaking below the 30 and setting that low point. So we're not there. We're not anywhere close. But we're also pretty bullish, and it's, again, I don't think we'll make a run on in the next 4 or 5 days up to 3,000, right? It's really hard right now to maintain, barring any news headlines like we saw in late 2017, January of 18, where the markets extended that intermediate run into the 5th month eventually. That January of 18 was that 5th month. It was those tax reform headlines and New Year that pushed stocks up higher, and we saw what the consequence of that was. So barring that happening, that was an anomaly, not the rule. The rule is that we'll start to grind our way back down and then make this intermediate pullback over here. And that's, doesn't mean it has to happen tomorrow. We can still grind away for a while, but the rally, the momentum, barring the right headlines, the momentum to the upside is going to be very, very muted now. As I mentioned, the range is really, really tight. And again, when you look at what the numbers actually were here, 1.37, well below the average on SPY, and also filling in the gap, so that includes the whole day's trading. And then volume was a measly, 40 million shares trading here. 40 million, this number here, 40 million shares traded. Just to kind of give you, again, context into those numbers, 1.37, well below the 52-week low for the ATR. 40 million shares trading, well below the average, the 52-week low average for a 4-week average. So I mean, very, very, very low numbers coming out of expiration. Remember, the idea is, we can be bearish coming out of expirations. We've seen this. Lately, we've been really sideways, if not a little bearish. We've been kind of sideways coming out of expiration, and that's kind of where, but we were bullish heading into expiration all of these months. You see here into January, into February, into March, and into April, we were the least bullish out of all the months so far this year. And those past 3 months, at best, we were sideways, and we'll see what we end up being today, where before we were pretty bearish, for most of last year coming out of options expiration Fridays. Let's take a look at the volatility index, and you can see volatility jumped up today at the beginning of the day, and we're down to 12.5. We're down in the midpoint again. I've mentioned to you before, this is a very similar pattern to what we saw right before our intermediate pullback here last summer, where we finally dipped below the midpoint of the bullish range, but we couldn't stay below it. We would dip down, get back above it, or we're dipping down, getting back above it, dipping down, getting back above it, dipping down, almost got back above it. So it's a very similar pattern that we had last time before we got the intermediate pullback. It did not get to an extreme, just got up to 1, and then it came down and then got in, traded both up and down in the upper and lower half of the bullish range, even getting down to extreme lows that we haven't really touched yet. See, we didn't touch it over here, but we finally started to touch it over here in August, September, October. So that's kind of what we'd expect after an intermediate pullback. This is what we're seeing now is what we'd expect before an intermediate pullback, especially since we are 3+ months into this current intermediate run. So to summarize, the markets continue to be bullish. They're grinding. They're in grind mode, which is low volume, low trading range, very boring. But also, as you'll see here, when we look at some other charts, we're starting to get low correlations. There are some bearish sectors, as we know, with healthcare. So we're seeing signs that an intermediate pullback is coming up. Timing that pullback, obviously, is impossible. But we can see the signs that are coming. What that tells us is we just manage our risk. We balance our portfolios, so we're not too heavily bullish if and when we do get that pullback. And the nice thing is correlations are small, so we can be bearish in areas that are bearish, right? And we don't have to. Not everything is bullish, so we can balance it actually in areas that are already bearish, and also we can keep our risk smaller on those bullish positions, and cut our position sizes until we get that intermediate pullback and subsequent bounce, and then the prospects of a new 1 to maybe up to 3 months of a run. So when that's going to happen, we don't know. So we can still trade this bullish trend, being mindful of the risk factors of its old age, which doesn't matter for long-term trends like secular cycles, but does matter for intermediate, these short kind of intermediate, multi-month intermediate runs. All right, so with that being said, what do you think? Do you agree or disagree with that? Now's your chance to vote. Click that link that's popping out up there. It opens up a poll. Then hit either agree or disagree if you agree with that outlook or not. If you click disagree, scroll to the comment section. Let me know what you're seeing. Obviously, everybody's got different opinions, and would love to see if you disagree with that outlook we just came up with. Share with the community here what it is you're seeing that either would make you a lot more bullish than I am, or a lot more bearish than I am right now as well. All right, now let's transition into what's driving the price action today. You can see the biggest mover today on the positive side was crude oil. On the downside, it was agricultural commodities, down 1.2%, crude oil up 2.7% thanks to those Iranian sanctions being renewed. Agricultural commodities is an interesting story because they typically move in conjunction with trade deal expectations. Not a lot of chatter about the trade deal, but you can kind of see what's happening there. In fact, they're kind of down to a 2-week low point. Agricultural commodities and crude oil up to a 2-week high. So that's kind of helping keep stocks from dropping, right? There's a good correlation right now between those two risk assets. You can see small cap stocks. It hasn't kept small cap stocks from dropping. So small cap stocks did have a down day today. In fact, even the Dow. Now, granted, the Dow is a price weighted average, and emerging markets were down today too, despite the fact that the dollar was not up, right? So developed markets, you can see, are up over the 2 weeks, down the least. Developed markets outpacing emerging, and S&P outpacing small caps. So a little bit of a, despite, even with the crude oil, and that's not really a risk on, that's more of a supply issue rather than the demand issue. All the rest of this, not really the most risk on patterns here. In fact, more risk off than anything. The only thing that really wasn't risk off is you have long-term bonds that were down, so yields were higher. They underperformed. With a smaller loss. High yield ends up with a smaller loss, but you can see emerging markets, despite their weakness, still did better from a bond perspective, and investment grade still did better than high yield. So again, kind of some wishy-washy there in terms of risk appetite. And growth stocks, interestingly enough, growth stocks did well today, as they have been doing well here. And then on the other end of the spectrum, dividend stocks were down, and value stocks underperformed. So I mean, a couple relationships where things are more bullish in terms of risk appetite, but for the most part, not so much, right? And that's why we're sideways. But that's also why we're sideways, leaning towards pullback, because we have these risk off things that are happening, at least today, right? I mean, if you look at today's chart, this is what it looked like here. Go to April the 22nd. Go to a 10-minute chart. And you can see crude oil was the only thing. I mean, the S&P is up because of that, but that was a huge outlier to the upside, and everything else down except for long-term treasuries, which you would expect to be up here with gold, and it was down today. Again, kind of yields can move when crude oil moves up. Yields can move up with it, right? It's kind of a reflection of inflation expectations, but also keep in mind too that yields are coming off of extreme lows, right? So, you see how oversold we were on yields. Remember, we had the clusters on the weekly chart on the market forecast. for the 10-year yield. There's a daily cluster that we had. But if you look at the weekly clusters, we had 3 weeks in a row where we had weekly clusters. So I mean, we're not on the weekly chart. We are dark pink shading with a dark red line. Now that dark pink shading is going to turn light green here. The intermediate line is close to crossing above 20, but it's not going to be a green moving average anytime soon. So we're not trending higher in yields, and we're just bouncing higher from extreme oversold conditions. The dollar, which bounced up so much on Thursday, could not follow through with that. And again, it would take a bullish trend on yields, and it would take bullish interest rate hike expectations. And you can see even by the furthest out that we can go, we have very, very low odds of an interest rate hike. In fact, interest rate cut odds rose. The odds of staying where we're at here fell pretty sharply from a week ago. And the reason why is economic indicators. You can see existing home sales were down 5.4% year over year from 2.3, which is what it was revised to from last month. You can see how we had a spike in existing home sales, but then we also had a couple of really small months preceding that, so kind of wash that out, and we're back to where we were. We have this declining trend in home sales. It's just about every other economic indicator, and you can see the National Activity Index, the 3-month moving average, continues to go down as well, and is in negative territory. So all that being said, we have really economic indicators continue to come in below estimates at a really sharp level, and that will put pressure on interest rate hike odds, which will put pressure on yields from a trending perspective, as well as the dollar. Won't necessarily push them down because the interest rate cut odds are still relatively low. I mean, 56%, we're below 60, and by the end of this year, we're actually, even despite the move up that we saw today, in those odds for easing. Give it a second here to load up. Looks like it's taking a minute here to load for some odd reason, but the odds are still around 50% for even the end of this year. So, I mean, that's a coin flip. It's not low odds like it were, but it's also not high odds either. So there isn't a rate cut imminent. And remember, again, the last time we had an interest rate hike cycle that ended, it took over a year before we finally got the first rate cut. And the yield curve was inverted, the 210 yield curve, which is still not inverted yet, right? If you look at the yield curve here, we're still not inverted yet. Again, the last time we stopped cutting rates was hiking rates, was well after the yield curve inverted, and then we had a whole year before we finally got our first cut, which was actually in September. Right here, and this is how far up the yield spread moved by the time we got the first cut. So the market will price in the first cut well before we actually get it, as you can see from this chart. We're not to that point yet, but that will be, when the markets are a lot closer to their long-term highs, and getting more of that long-term pullback that we haven't seen, and kind of a recessionary type pullback that we haven't seen since that time frame. Even if we've had some pullbacks since on the stock market, just where global recessions were in place, but not necessarily here in the U.S. Similar to what we're seeing right now, actually. And as I mentioned to you before, not all sectors are performing the same. The correlations are starting to drop. In fact, you can see utilities now has dark pink shading, so we're below 50 and falling on the intermediate line. And we have a dark red line, saying not quite there on real estate, but we have the dark pink shading now. We're below 50. And of course, healthcare. I think the low is set in on healthcare here. Could be wrong on that, but I think the low is set in here, at least for a while here. I don't think that we'll be bullish trending anytime soon, because you can see how far we are below that moving average. But we probably won't drop this sharply anymore without, basing a little bit first and then pulling, continuing further. I venture to guess by the time it makes its next leg down, the rest of the market will make a leg down too. That we'll finally get that intermediate pullback. But look, you can see everything else is pretty darn bullish. Materials down a little bit. But energy hitting a 3-month high. Now pretty flat. It's pretty flat, but it's finally hitting a 3-month high point here. Everything else pretty close to 3-month highs. Technology 3-month high. Financials close to the 3-month high. A little bit of a pullback. Communication services 3-month high. Consumer discretionary just barely down from a 3-month high. Staples close to its 3-month high. So they're all pretty darn bullish. But you can see I can balance out my portfolio with areas that aren't as bullish in some of these sectors. You can see real estate down the most today, down a full percentage, even with the market kind of flat. You did have an outlier to the downside from multiple, a cyclical sector, a dollar-sensitive sector, even if the dollar wasn't necessarily up, and then an interest rate sensitive sector. On the other side of the spectrum, you have energy, not surprising, up today with the big move in crude oil. A cyclical sector here, a couple of cyclical sectors continuing to outperform those momentum type growth stocks we saw with IVW performing as well as it did. Of course, one of the stocks and one of the sectors, the cyclical sectors not doing so well, is the retail sector. And you can see Nordstrom, which hasn't been doing very well anyway, and is trying to base and was trying to get going and couldn't quite get that bullish combination and keep it of dark green shading, dark green line. Well, now we broke down the new 52-week lows today. So breaking below these lows, you can see the intermediate posture strongly bearish, dark red line. Here you look at the 3 red arrows for Nordstrom. You can see we have 3 red arrows also, and a little bit of above average volume considering the rest of the market's volume was relatively below average. You can see it broke below its lower Bollinger Band today, and look at all that volume up above here that's going to act as resistance. So very low bandwidth has the potential to rise and breaking below the lower bandwidth. And you can see the DMI indicators here. There we go. You can see the DMI indicators also showing a bearish pattern, the DMI negative line crossing above 26 for the first time in a while, right? This whole sideways trend that we've had. And then you can see the negative, this stochastic extreme falling down, the oscillator falling down, showing bearish signs too. The momentum, the positive line hasn't fallen below 20 yet. That's your combination that you'd like to see. So that's why their ADX is still really tight. But, again, pretty decent volume. And then you look at like the long-term charts for this and how bearish we are. And you can see closing below all these lows, pretty significant bearish trade. Now, how far down can we go? There's not we can get down below 40 before we start reaching relatively recent lows. So we don't want to be too aggressively bearish, but we can sell calls here at 43.5 for May, and option or earnings is coming out after May, and we still have enough time. See, there's the earnings coming after May expiration, and we still have enough premium here to sell the mid 30 delta and still get a 30% return on risk, depending upon where you get filled in. 47% on a $2 wide, 47 cents on a $2 wide spread is 30% return on risk. So, with only 25 days, we're still getting pretty decent return on risk. Still getting pretty decent probability of success of getting. Remember, we're only going for $47. That means we're only willing to lose $47, which is on the other side of this $44. And remember, we have some strong resistance up here. Even right below that big volume node here, you have a volume node here at 44. That's also going to act as a resistance at the top end of this candle, and basically at the exponential moving average that's in between in the middle of the Bollinger Bandwidth there. So you can kind of see where we would get out with a loss from a technical perspective, basically getting above last week's high here at the end of the week, and then trying to contain any loss to what we're trying to make on this. But you can also see we can get, we can get a lot of this gain here. Even as of today, we can get to our halfway mark without getting down below that $40 level, which is where there's going to be, from a long-term perspective, some support. That's only a couple, relative. It wouldn't be a very strong support, but there would be, there's some lows here around $40, right? There's some volume in here, so it's not gonna plummet, but as long as it stays down, that's all we need, right? Because again, as time passes to get to this midpoint here, which is where at $40 right now. As time passes, you can see I know now it only needs to get over, into $41, right? As if we wait just a week, so you can see, that's we can get time on our side. We don't have to have it go straight down. That's the benefit when you trade this style of trading, vertical spreads. The difference, the important thing is you have to keep your losses. So you have to force yourself to take small losses, because if you don't, then you'll end up taking these big $153 loss, which takes a lot of $47 gains at maximum gain to be able just to offset a $153 loss. All right, well, that wraps us up for today. As always, now I want to hear from you. Use that link that's popping out in the top right corner of your screen to go to our forums on marketscholars.com, specifically our Market Outlook forums. Open up any new thread you want, ask any questions or comments from tonight's video. Remember, you can also ask any questions or have any comments about anything we didn't discuss in tonight's video. And also remember, too, you can reply to anybody else's thread. You don't just have to wait for me to respond. There's more to our Market Scholars community than just Brandon and myself. Of course, thank you very much for watching tonight. We appreciate that. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment on our videos. Follow us on Twitter for more content in between videos, and join our community on Facebook and on marketscholars.com. Thank you again, everybody. Have a great rest of your evening, and we'll see you all next time.